Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So over the past couple of weeks, there has been quite a resurgence in so-called value stocks, and there has been quite a significant pullback in many of the so-called growth stocks. And if you've watched pretty much any of my videos before, you will know that I don't usually tend to categorize stocks into value or growth. I really abide by kind of Warren Buffett's mantra of value and growth are joined at the hip. They're two sides of the same coin. If you have, two companies and one happens to be growing at 10% a year and one happens to be growing at 30% a year, all things being equal, the company growing at 30% a year will have a higher value. So growth is a very important part of the overall sort of value equation. Nonetheless, there have been a couple of key changes and I guess sort of market expectations on the traditional value type stocks and traditional growth type stocks that people tend to try and label. And we've seen many of the value stocks do really well over the past couple of weeks, and we've seen many of the growth stocks do quite poorly over the past couple of weeks. And I'm not generally one to get caught up in short-term market movements, and certainly not one to focus too much on overall whole market macro type stuff. I tend to prefer to try and understand individual businesses and make kind of decisions on individual companies from sort of a bottom-up type approach. But there are a couple of key things that have changed, which I think can really be explained by some basic mathematics. So that's what this video is all about. I'm going to talk through a couple of the key things that have changed in terms of how people are going about valuing these different types of businesses and how I think that is influencing their market prices. Now, in order to explain what's going on here, you first have to understand that the stock market is a discounting machine. Now, what I mean by that is that the stock market is simply a collection of businesses, and the market has expectations for what those businesses are likely to earn out into the future. And based on those expected earnings, the stock market then looks at those future cash flows, discounts them back to today at an appropriate interest rate, a rate of return that they want to make, and then comes up with a valuation of those businesses as they are today. That's what the stock market is doing. That's how people typically go about valuing particular businesses. And when you combine the individual valuations for all of those different companies, you get what is referred to as the stock market, or an overall sort of index valuation. Now, we all know that the stock market fluctuates wildly, both up and down. And market expectations for what these collection of businesses are going to earn out into the future are always changing. And really, two main things have changed in the past couple of weeks that have impacted these market valuations in this discounting machine known as the stock market. And that, number one, is interest rates have bumped up very slightly. And number two is that many of the so-called value stocks are expected to have actually better earnings than might have initially been anticipated only a few months ago. Firstly, let's talk about interest rates. Now, interest rates are quite a strong determinant for how people go about valuing businesses. If you can earn, say, 5% a year on a 10-year T-bill, you're going to want to earn a premium over and above that 5% by investing in the stock market. The stock market is typically perceived as higher risk and sort of more volatile. So generally speaking, people are expecting a higher return than whatever they can get for some sort of risk-free rate type investment with something like a government bond. Now, over the past couple of weeks, the interest rates on T-bills over in the US has gone up a little bit. Now, granted, those interest rates were very close to zero and they have moved up a small amount, but they are still very low in the grand scheme of, where interest rates have been in maybe the past 20 or 30 years on average. But nonetheless, even small movements in interest rates, especially when they were starting from such a low base, can have quite a dramatic impact on overall market valuations for stocks. Let me put up a visual on the screen here. Now, this is just a hypothetical example of us buying a business that earns $1 a year in cash flows like clockwork. It doesn't grow, it doesn't shrink, it just earns $1 per year. Now, we have to figure out as buyers or investors in that particular business what would be a rational price to pay for that company that earns $1 in cash flows every single year. Now, let's hypothetically say that this business is going to earn that $1 a year for the next, say, 40 years, and in year 40, something happens that causes that company to go bankrupt. So it suddenly goes from earning its $1 a year like clockwork to earning zero, and it's never going to earn more money ever again. So Over the next 40 years, we expect to receive $1 in cash flow every single year, and we have to figure out what's a rational price to pay for that total $40 that we're going to receive over the entire lifetime of that investment. Now, there are some numbers that you can get to, just kind of back of the envelope calculations and things here that are obvious things that you wouldn't pay for this business. So we have a company that's going to return to us $40 over the next 40 years, $1 per year. It probably wouldn't make sense to pay $100 for that business. If you get rid of $100 today by buying that company and you're only going to receive $40 and you have to wait 40 years to get that $40, that's not a particularly attractive investment. And you probably wouldn't even pay $40 for it because you're sort of sacrificing $40 today to receive $40 over the next 40 years. Now you have to wait that 40 years. That's kind of dead money for a very, very long period of time. So $40 isn't really a rational price to pay for that company either. But you would probably be more than willing to pay $1 for that business. You're going to get your money back in the first year, and kind of everything after that is just cream on top, and you're making very strong returns on that particular investment. Now, the magic number of what would be sort of a rational price to pay for that $1 in cash flows every single year can be calculated by a discounted cash flow. In a discounted cash flow, you put in your future expectations for that business, which in this case is $1 per year for the next 40 years. And then you can also put in what's called a discount rate or an interest rate, which is basically what you would like to earn on that particular investment. What that discount rate does is it basically reduces the present value of some of those cash flows out into the future. So even though in nominal terms this business is going to earn $1 per year every single year like clockwork, you have to wait for a good proportion of that money. So you might get paid $1 this year from the business, which is fantastic, but if you get paid $1 next year, you have to sort of account for that waiting time. And if you earn $1 the year after that, again, it's a bit of a longer wait again, and you have to sort of earn a reasonable return, on your wait time to receive that cash. And that's what a discount rate basically does. So it's saying that $1 earned today is far more valuable than $1 earned in 10 years or $1 earned in 20 years. And the rate at which we sort of reduce the value of those future cash flows in present value terms and today's terms is really dictated by that interest rate or by that discount rate. So how on earth does this relate back to the high-flying growth stocks and less high-flying sort of value stocks that we're seeing sort of market price movements for over the past couple of weeks? Well, basically a lot of the intrinsic value for growth stocks is really attached to the cash flows many years out. So a lot of these companies are earning maybe very little money, maybe some of them are even losing money and expected to do that over the next sort of 1, 2, 3 years. But a lot of those companies have very high expectations on the cash flows that they might be able to produce in 5 or 10 or 15 years. Now, if we have any sort of change in interest rate or in discount rate, it's going to have the most dramatic effect on cash flows that are furthest away. If we have an expectation to earn 10% a year on our investments, that then goes to 12% a year because we have increases in the risk-free rate that we can capture in bonds and so on. That means that we're going to increase the discount rate or the interest rate on our discounted cash flow, which means that cash that is received further away from today is even less valuable than it was with a lower interest rate or a lower discount rate. So with many of these high-flying businesses that have fairly modest expectations for the next couple of years, but really high expectations many years out into the future, those are the ones that are typically the most affected when we have increases in interest rates like we've seen in the past couple of weeks. Now on the flip side, we also have a group of stocks where most of their value is accounted for in near-term cash flows. And these are the types of businesses that people typically refer to as value stocks. The low PE, low growth, low price to book, all these sort of boring stocks that don't get a lot of people particularly excited. These are the ones where they're expected to earn a lot of cash flow maybe in the next 1 to 5 years, but perhaps not a huge amount of cash flow after that, or maybe the business is shrinking or it's not expected to have much growth, whatever it might be. Now, if you take a business like that and you run a discounted cash flow on it, it's not going to have as dramatic an effect on the intrinsic value of those businesses as it might on a very high growth company where you're waiting on a lot of those cash flows to be received a long way out into the future. And that is why, generally speaking at least, the so-called value stocks typically perform a lot better when interest rates are going up versus the growth stocks, which tend to get a little bit more beaten up, but they also tend to perform a little bit better as interest rates are going down and you're sort of putting a lower discount rate or lower interest rate on those long-term cash flows. The second thing that is impacting some of these valuations, and particularly on the sort of value stock, lower growth stock kind of side, is that market expectations have changed somewhat for what people expect the earnings of those lower growth businesses to be over the next couple of years. We've had vaccine rollout start, for example, and a lot of the so-called recovery stocks have really sort of bounced up as a result of that news. And that again is for fairly simple mathematical reasons in this exact same equation of the discounted cash flow. Now, remember, the value sort of lower growth kind of stocks tend to have more of their intrinsic value attached to the cash flows that they will produce in the very short term, in the next 1, 3, 5, 6 years, something like that. Again, I'll put an example up on the screen here where we have a business that earns $1 per year, and let's say it's just going to earn $1 like clockwork for the next few years. And then I'm going to go in and change the market expectations. Let's say that this business is going to now earn $1.50 next year and $1.50 the year after that, and then maybe it returns back to $1 and kind of goes back onto normality. For some reason, it had this short-term spike as kind of expected. Now, this is what you might expect to see in the outcome of intrinsic value through that calculation. You'll notice that the near-term cash flows for those value stocks tends to have quite a significant impact versus updating the long-term cash flows. If I do the same thing and change a couple of the years from $1 to $1.50 in earnings, but I make those years really far out, it has less of an impact on the intrinsic value for that company. So that's my summary of what I think is going on right now. Again, I'm not typically one to get too caught up in market expectations and, overall stock market stuff, but I think they are a couple of key trends that are really quite important to understand, particularly the interest rate one. So those are my opinions on why I think that value stocks have started to do pretty well over the past few weeks, and growth stocks have done quite poorly as a whole and aggregate over the past few weeks, is simply because interest rates have changed and also market expectations have changed somewhat as well. Of course, all of this could be completely temporary and it could change tomorrow, it could change before I even upload this video to YouTube, but hopefully those concepts will stick with you and help you understand kind of the mechanics of how this discounting machine called the stock market kind of works. So hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.